Hi, welcome to the latest edition of our video blog. And in recent months, we've spent most of our time sort of talking about general market views and a sort of more macroeconomic perspective on what's been going on in the world. And we thought we'd do something a little bit different this month. And actually, I would sort of drill down a little bit more into actually what we sort of do on a daily basis in terms of looking at stocks, in generating new ideas, and in sort of monitoring our portfolios. And seeing that we've got the best companies in there to make the best return. To illustrate this, I thought I'd sort of go through, in somewhat general terms, a specific example of a company which we have invested in the last 6 months, and show you sort of how we got to the idea, where it came from, and how we keep on top of it. And this company is Domino's Pizza, which is a UK company in the leisure sector. Which we've invested in, as I say, in the last 6 months. Now, the first point, whenever looking for companies, is generating new ideas, and these ideas can come from anywhere. They can come from the newspaper, they could come from talking to other companies, they can come from just walking down the high street, seeing something, and then going back and doing a bit of research in it. But we also use sort of a number of slightly more formal screens, perhaps, which sort of look at certain parameters, and certain stocks might flash up there as being particularly appealing. Things like if they are producing on a steady basis growth rates in excess of, say, 20% per annum, if they appear particularly undervalued, if they're only on less than, say, 7 times earnings, or also more sort of vague things, if they seem to be particularly overloaded. You can tell this by if they've got a preponderance of sell recommendations from brokers, and also sort of momentum and trends that you might see in stocks which have either price or analyst estimate momentum behind them. Now, an example of Domino's, it was really growth which sort of flashed the alarm bells and made me think maybe it was one worth looking at. And the first sort of step is very much general in the office. Has anyone looked at this company before? Does anyone think it's worthwhile? Assuming that no one says, no, this thing is not worth your time of day, which is virtually never, because it's always worth looking at these things. Then the next step is to go to the company website, download all the annual reports, watch the sort of earnings results, listen to any conference calls, webcasts, sort of get a feel for the company, more from the inside first. I think it's, we often like to do that before we'll go and speak to the analysts and the brokers, so that we can get a sort of fresh, unbiased point of view to start with. Doing this, we sort of start to build up our own sort of informal internal models a little bit, and get an idea of where we think the company's going, and what we think the earnings power might be. And the next step is then probably to talk to various brokers, various analysts, get them in. In Domino's case, it's very much the sort of UK small and mid-cap brokers, specialists, that we would get up on the phone. We download their research, and we try to see what they think about the company. And it's usually a good idea there, and what we try to do is get a sort of a range of opinions, not just speak to one broker all the time. And particularly if it's a stock, in this case where we thought this looks appealing, it's got high growth, it's useful often particularly to focus on those that are negative on the stock, and those that are that maybe things won't be quite so rosy. Always a good idea to get a very broad range of opinions. The next step, and this is true in Domino's and in most cases, is to try to actually see the company ourselves before we invest in them or decide not to invest in them. As I say, in this case, one of the major bulge bracket banks was having a small mid-cap conference in London. It was possible to get a one-on-one meeting with the company, and I went and did that and had an hour-long meeting with the company where you get to question the CEO and the CFO, which is very, very useful. I mean, okay, sometimes they don't necessarily tell you things which you wouldn't read in the annual report explicitly. However, there's a lot you can tell both through their body language, through the general sort of tone of the meeting, what they feel like, what sort of personality you get off them, and the general sort of vibe can actually be almost as important as the strict numbers that you might read in the report. And the great thing as well about the UK and about stocks in the leisure sector particularly is that you can actually go and sort of sample the product. And this is the case with Domino's. I tried ordering online. I tried testing out all the different sort of routes to market through, in the shop, over the telephone, over the internet, and really get a feel for actually what the consumer experience is like. And I'm somewhat spoiled because I look at UK stocks, and obviously these companies are all around us. It's a little bit different if you're investing in something halfway around the world. But actually, again, that even though it's not going to be giving you an overall perspective of the entire company's earnings prospects, but actually it can be very, very useful for seeing if things feel right. Now, throughout this process, even if an idea seems good at the start, it may come around and end up turning into complete rubbish by the end. And I think one of the important things that I try to do, and I think we all try to do, is keep an open mind at all times and be prepared, even if we like something to start with, to be at the end say, I wanted to like it, but I couldn't. These are the reasons why. And that, may often be the case. If we get through all of this process and we like the company, we've looked at the numbers, we've done a bit of modelling, and we think it looks very appealing, the next things to think about are valuation. Is this stock realistically going to be able to outperform? Maybe it's had an extremely good run. We'll look at the chart, see what the momentum is behind it. In the case of Domino's, again, it was on a premium rating. However, we felt that because of the growth in the company, it was worth still thinking about investing in it. And then we will also, in the office, we'll have stock meetings on a weekly basis. And if there are ideas like this that I've been looking at, there may be half a dozen that any of us are looking on any given week, we'll then bring them up and say this is something maybe we should think about putting in the portfolios. Of course, because we're a small office, it often doesn't have to be a sort of formal meeting as such. We'll just be bouncing ideas around each other and discussing things constantly anyway. Once we get to that point and we've decided, say, that we do want to invest in the stock, as we did in this case, then I suppose the sort of final thing we think about is liquidity and the size of the company. What size position could it be in the portfolio? Is it something where we could buy 3-4% and be quite happy that we weren't going to run into any problems should we need to sell it quickly? Or is it something where really we need to take a much smaller chunk? In this case, the company was only less than £1 billion in market cap. It doesn't trade that regularly, therefore we ended up taking quite a small position. However, again, we're constantly on the lookout, and in fact, in this case, we added to our position slightly when we saw that there was a placing of the shares a couple of weeks after we made the initial purchase. Of course, things don't stop there. Once the positions are in the portfolio, it's about constant monitoring whenever there's results. Whenever there's earnings announcements, conference calls, and in fact whenever the companies are going on road shows, it's always useful to see them, keep on top of things, make sure that you're still happy with the management, etc., and be prepared to reevaluate the investment case at any point. And that's really the key, I think, to deciding whether we keep things in the portfolio or whether maybe it's time to sell and make room for new ideas. Is does the original investment thesis and the original investment case still hold up? Can you still make an investment case, or in fact are you just holding it now for the sake of it? And of course, background to the beginning, it's then constantly looking for new ideas again and trying to find out ways that we can incorporate that. Well, I hope this has been useful. A little taste of what we're sort of doing on a day-to-day basis, and gives a little bit of flavour of what it means, when we're choosing to buy and sell these stocks. Thanks a lot.